With the new US administration at the helm, investors around the world are eagerly preparing for what is to come regarding domestic policy, international policy, tariffs, and geopolitics. But how will fixed income strategies navigate this new pathway? What factors are at play regarding fiscal policy? And how can investors prepare for the year ahead? My name is Anu Rajakumar, and joining me today is Ashok Bhatia, Chief Investment Officer and Global Head of Fixed Income, who's here to guide us through these intricate dynamics and share his insights on the asset class. Ashok, thanks for joining me today.
Thanks, Anu. It's good to be back.
So Ashok, in the Q1 2025 fixed income outlook that your team published, and also in our Solving for 2025 market outlook publication, you predicted an important shift for bond investors this year, essentially going from being, intense Fed watchers, with a focus on monetary policy to instead focusing more on fiscal policy going forward. So can you begin by recapping that for us and talk about why you think this is an important shift?
Yeah, it's, I think if you take a bit of a step back for the bond markets the last 2 to 3 years since the end of the COVID crisis, we've all been very focused correctly on what the Fed is going to do. First, the Fed had a hiking cycle, and then the Fed has had, in the process, an easing cycle. But the dynamics and what's impacted bonds and bond valuations and curve shape, it's largely been driven by the Fed and getting that path of tightening and easing correct. And the big shift for this year is, our view, as you mentioned in our quarterly, we make the point, the Fed's probably still easing this year. I think, right now as we record this today, the bond market and bond market participants, feel like the Fed might just be on hold or even hike. We're in the camp the Fed will ease again this year, probably twice, maybe once. But the shift is really that the Fed is going to recede to the background. One ease, two eases. The Fed's going to be at a spot where we think they can hold rates for an extended period of time. And at the same time, the fiscal dynamics are suddenly increasing pretty quickly. And, for a bond investor last year and the second half of last year was particularly interesting as budget deficit concerns started surfacing. France, the UK, emerging markets, and then obviously discussion on this in the U.S. And we break, what the fiscal policies that are coming, and it is, part of it is just trends, but part of it is the new administration, is that there's really three big elements of what fiscal policy is going to matter for the bond market. One is the policies, around tariffs. What will be the inflation impact of that? Will there be a growth impact? But call it tariff policy. The second will be, immigration policy. And what does that mean? That can have impacts both on growth and inflation as well. And then, the third big bucket is the budget and what will be this administration's priorities around taxing and spending and how that will impact. And you can kind of pull in deregulation here, what that will mean for potential growth for the U.S. for the coming years, as well as the impacts on, growth and inflation as well. So we're going to this environment where the bond market and, it's ultimately the economic variables that drive where bond yields go. The impact is coming from the fiscal side and just a lot less from the monetary side. And it's going to be an interesting year and frankly, a trickier year to navigate, I think, for the bond markets.
Yep, terrific. And, you mentioned the impact on, inflation and growth and how these various policies are going to affect those. Let's talk about inflation for a second. You've identified in these publications that you expect inflation to soften in 2025. What's going to drive that, and how does that expectation line up with, as you mentioned, some of the policies of the new administration that may contribute to inflation going up? Again, you mentioned tariffs and immigration limits as well.
Yeah. So on inflation, and, our view is, core inflation in the U.S. is, roughly around, 3.2% year over year, last 12 months. And we think core inflation over the course of 2025 will decline to something around 2.5 to 2.6%. So, that may sound only like 0.5%, but that's a meaningful fall that moves you closer to sort of the Fed's targets for where they ultimately would like core inflation to get to. And so we do think this is a year that will be a continued year of disinflation. And this year, a little bit more driven by just ongoing softening in the housing markets. And that's not that house prices are going to start going down, but a little bit more stability or smaller increases in houses and rents. But importantly, we think also, the labor market is coming back into a little bit better balance. That will result in a little bit lower wage gains. People will still see wage gains, but a little less, and that's less inflation impetus into the economy. So, our view, and I do think, with where we sit in the markets today, that's a little bit out of consensus to view that this is a year of disinflation again. But then, Anu, as you mentioned, we have these policies that can be coming in, and tariffs, a lot of it obviously will depend upon the exact policies. But, our base case is some tariffs, phased in tariffs, maybe a bit more of a negotiating stance at the end of the day. But something that can raise inflation rates this year by, 0.2, maybe 0.3. It can change the amount of disinflation we have, but it doesn't change this from a disinflationary to an inflationary year. Like, we struggle to see how tariffs could result in that kind of a dramatic shift. And then, similar, you mentioned, immigration, and this is a much trickier issue, I think, to disentangle all the economic impacts. But at the end of the day, our view is that if we're obviously, and it's already, happened, that, legal and, illegal immigration into the U.S. right now is falling. But the deportation policies, what we get there, and really how much is this going to touch the workforce, or is this going to be, in the sort of people in jails, criminals, those types of things, people that probably aren't in the workforce. That's a bigger issue. And on that, we see actually bigger growth impacts from that, depending on how extensive it is, than inflation impacts. So at the end of the day, we're not seeing anything that can change dramatically the inflation picture for this year right now.
Yep, sure. Well, and maybe transitioning to the growth picture, the new administration's policies are expected to be fairly pro-growth and pro-US. So maybe talk a little about what you think those drivers of growth will be. And, is it the consumer? Is it elsewhere? And also, do you think that the US is going to lead other developed market economies?
Yeah, those are some great questions. I think, on the growth impact, we can have animal spirits, we'll have some deregulation, but the way we're thinking about this is it's unlikely to move the needle an awful lot on growth in 2025, right? A lot of these policies are more aimed at increasing trend and increasing productivity growth for the U.S., and those are things that will just take longer. I mean, we're unlikely to get even a budget agreement until the spring at this point, much less when it gets implemented. And the tax regime and tax cut regime probably not changing, this year, next year. So I would say think about the growth impact of these policies as more being 2026, 27 events. And, as you said, I think base case should be that these are going to be policies that are aimed and likely would increase trend U.S. growth in those outer years. As for pulling, on the rest of the world, our bias here is that, the U.S. is still the largest economy. We are largely still, I think it surprises people, more of a closed economy where our tradable sector and exports and imports still a relatively small part of our economy compared to a lot of other places. So the U.S. will have growth spillovers. If we do well, it'll naturally drag up places like, Mexico and Canada. But for the rest of the world, for example, Europe growing faster, China growing faster, those end up influencing a lot more countries than the U.S. Picking up a little bit more growth.
Yep, sure. Well, thank you for sharing the macro views. You've put a good backdrop here. So now let's talk about what all this means in terms of areas of opportunity and risk within fixed income markets. Where should investors look, given spreads are tight in credit and other areas might be challenging? Where are the opportunities?
Well, I'll just start with the first basic, is this going to be a good year for fixed income? And I recognize the bias of being a fixed income person, but I will say I think the setup for this year is, I think, and it's surprising maybe, but it's a much better setup for bonds and bond returns this year than last year was. If you go back to last year, I think it's this question of, hey, the Fed eased, 100 basis points last year. And if you look at the broad bond market indices, they were up 1 to 1.5%. I think intuitively you would think, hey, if the Fed eased 100 basis points, bonds should have had a really strong year. And they didn't. And if you disentangle why, it was really two things. It was first, yeah, the Fed eased 100 basis points, but the market was expecting them to ease 150. So the bond market or the Fed under-delivered to what the bond market had priced for the start of 2024. And then, the second issue for the bond market was, 2024 started the year with a 10-year Treasury rate sub 4%. We ended up going almost up to 5% last year. So we also started the year with very low long-term yields. Some of the things we're talking about today on deficits and debt, those weren't really on the market's radar screen. But you flip through to today, and I think there are a couple of key differences for the bond market that make us, more optimistic. One is the bond market's really only priced for the Fed to ease, 1.5 times this year. The hurdle rate's pretty low. So you don't need the Fed to do an awful lot for bond yields to be, in our view, supported around these levels. The second issue is that these deficit concerns, they're more in the price. With where long-term yields sit, we would argue that the bond market is equally exposed to bad news on the deficit as it is to good news. Imagine a world where in March we get a budget deal that says, hey, that the bond market's conclusion is deficit maybe not be coming down, but it's not getting any worse. And there's, the proverbial light at the end of the tunnel. We would think that's going to be a positive event for long-term bonds as well. And then, the third and perhaps maybe even the biggest issue is just the income dynamics. The policy rate, and, for anyone listening that maybe has, savings accounts or bank accounts or, money market accounts, your yield on those is going to be, plus or minus, it's going to be around 4%. It's no longer 5 3/8, which is where the policy rate was a year ago. So the cash rate is lower, and suddenly a lot of these government bonds and yields yield more than that. So there's positive income available from moving out of cash. And that's a dynamic we also think will support fixed income, is that, as people sort of look and say, hey, I can pick up 50, 100, 150 basis points by doing some maturity extension, that helps fixed income. So I kind of forgot what your exact question was to start this, but I do think if, the outlook for fixed income this year, I think we're building a pretty strong base from where the rates markets sit. And then you did ask about credit spreads, and you're absolutely right. Credit spreads are tight. They're low. The amount of extra income or yield you get for high yield or investment grade credit, however you slice it, these are the low ends, very low ends of historical ranges. And our view here is just don't expect a lot of fireworks. Credit spreads last year were pretty range bound. They weren't that volatile. It was because fundamentals remained strong. And, the environment that we think happens this year of lower inflation, decent growth, Fed sort of easing a little bit, it's hard to see that disrupting spreads a lot. So I think investors should approach this year thinking there's a little bit of downside in bond yields, and credit spreads broadly are going to be stable, and you can pick up a little bit extra income there, and spreads probably stay on the tight side.
Great. Well, you did answer my question perfectly, so thank you for that. Maybe just dig into it a little bit more. Are there any fixed income strategies or approaches that you think would be particularly effective at generating alpha? And for example, how are you thinking about duration management for 2025?
Yeah, I think this could be it's probably its own podcast, but I think if I take fixed income, and I've been doing fixed income for about 30 plus years now, and the bond market's gone through iterations. There was an iteration where you could even go back to the 1980s where the interest rate moves were these very large, powerful moves that drove a lot of the total return profile for bonds. And then, we went through a period, and it's really since the financial crisis when central banks pinned policy rates at zero and did a lot of bond buying. So when we got this macro volatility, some macro events, and there's obviously been a ton since 2008, right? There were two events where will the European Union survive, energy crises, et cetera. this all ended up being the volatility was expressed in credit spreads. It wasn't really expressed in interest rates because interest rates were at zero and couldn't go anywhere. But the world we've shifted into now is that this macro volatility, so these debates about growth and inflation, they now are coming back into the bond market. They're not going into the credit markets. And it's, if you just look at last year, range-bound credit spreads, but interest rates go all over the place and, hundreds of basis points of ranges. And for a bond investor, one thing I think to keep in mind is that, if you have a 50 basis point move in interest rates and a 50 basis point move in credit spread, for close enough for government work, those are equivalent total returns or excess returns. So if you can capture one and not the other, it leads to the same or substantially the same result for a client or any investor. And so I do think the bond market is in this world, and I think it's going to persist for a while where the volatility is in interest rates. But the change that's going to happen now is a bit more divergence between bond markets. The bigs up and big down moves that have generally been highly correlated, I think you're going to start to see the start of a lot more dispersion on that. And it's going to be important, whether it's us or anyone else operating and investing in fixed income, capturing the moves of interest rates, if the objective is whether it's total return or alpha excess returns, it's rising very rapidly as a necessity, I think, for professional fixed income asset management.
Yeah, that's great. No, thanks for sharing those thoughts about managing volatility in portfolios. And you painted a picture, generally, I think, of optimism for fixed income markets. What are some of the risks to that view? And maybe also just speak to the strength of the dollar as one element that might be a factor here too.
Yeah, I think, and it's great to come back to that and, for our views. And I think, you want to, start obviously with the recognition that we can be wrong about things for sure. And I think, one area is like if we are very wrong on the inflation, front, that if we're missing something, I think if there's something we're really missing, it would be more along the lines of the housing market, and we're over-optimistic about house prices and the inflation that's coming out of the housing system. But if we're wrong, and this is a year of inflation, it could be that the tariffs, it could be something else that changed that dramatically. But say an environment where the Fed felt the need to hike, that would be very disruptive for the bond markets, and I suspect for all types of markets. I think, we've gotten some hints on not hints, but actual data on the inflation print. But, that's regular data once a month. So I think that one we'll be able to pay close attention to. But that's clearly one risk. I think the second, which is related to tariffs, is I think, let's assume that the tariff policy is going to be starting from the U.S. side of things. In 2000, in President Trump's first term, I think it's fair to say the rest of the world was surprised and unprepared for this type of policy from the U.S. It was a pretty radical departure from the post-World War II policy from the U.S. But this time around, the rest of the world, they've got their retaliation lists ready to go, and the world is better prepared. So miscalibration on that front where the U.S. tariffs folks and then we get tariffed back and it leads to a quick decline in U.S. and global growth, I think that's a risk to be aware of as well. And then, the last one I'll say is that there's a lot of weakness in the global growth environment. Europe, Germany's in a recession, China's struggling with growth there as well. So I think this may be more of a risk for the spread markets, but if rates seem like, and this rise in interest rates has not really seemed to have bit or really impacted growth to any great extent at this point, but whether or not we're just missing that and there is a bit more of a global growth deterioration, combination of the rate hikes plus the global environment, and that all sort of kind of comes together, I think that's probably the third area that I would highlight.
Yeah, absolutely. So I think just to summarize the key risks, like inflation, tariffs, and weakness in global growth, those are all important things to keep an eye on. And as I often think when people answer this kind of question, asset management is a very humbling business. So, yeah.
Yeah, that's for sure. It's one day or 1 week you can feel like you're getting everything right. And then the next day or week, it's 180 degrees spun around.
Absolutely. Well, Ashok, thank you so much for sharing those thoughts today. I can't let you go without a quick bonus question. I know you just got back from a business trip to Asia, so I'd love for you to tell us about your favorite or most memorable part of your travels to the region recently.
Well, a U.S. bonus question, but I'll take the liberty of two answers. So I will say this: one is, it's the Chinese Lunar New Year that's starting, in a couple days over there. So we were over there for a lot of the preparation and celebrations for that, and just a terrific time. It's so many people like starting to travel to see their families, and the ceremonies and the festivities about it, in addition to the work meetings and client visits, that was a super fun part of it. The other thing that I'll say that I just find remarkable about, we were in Singapore, Hong Kong, and Taiwan, and it's, and I've been going over there as a regular visitor for years, but every time you go over there, the amount of wealth and prosperity that is, lifting a lot of different boats in the region. And, the change we observe, or I observe now, is India. We weren't in India, but you can feel the influence of a rising India with more wealth, and how that money is sort of moving throughout the region is, it's, you can always look around, I think, around the world and see all the negatives, but there are things going out there that, a lot of people are making, there's a lot of wealth being created, but it's also lifting a lot of people out of poverty and raising standards. And, Anu, just before we came on here, we were talking about even places like Thailand, where you're seeing, the growth of middle classes and the society. And that's a terrific thing to see in perspective.
Yeah, that's great. Thank you so much for sharing those thoughts and for just sharing your perspectives on the 2025 fixed income outlook. And as we've discussed today, very clear that evolving fiscal policies and the new U.S. administration's approach, whether it's tariffs or immigration, investors have a lot to consider as they navigate these disruptive forces, you could say. So Ashok, appreciate you joining us today, and we look forward to having you on the show again soon.
Thanks, Anu, and congrats on the podcast. I know this has been a terrific thing for all of us at the firm, and I hope all your listeners enjoy it as much as we do.
Thank you. That's very kind of you. And to that point, to our listeners, if you'd like to read more about the fixed income views expressed today, please visit our website, nb.com, where you can find the Q1 2025 fixed income outlook, as well as our firm's Solving for 2025 publication. And if you've enjoyed what you've heard today on Disruptive Forces, you can subscribe to the show from wherever you listen to your podcasts, or again, you can visit our website, nb.com/disruptive forces, where you'll find previous episodes as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.